This is Matt Graham with the MBS Live Market Update. What a difference 2 days make. On Thursday afternoon, mortgage rates were near the lowest levels in 8 months. And 2 short days later, not even 2 days later, they're up to the highest levels since the day before the last Fed dot plot on December 12th. That is an abrupt reversal. It can be attributed almost exclusively to Friday's exceptionally strong jobs report. There are some differences of opinion out there as to what those numbers actually mean and whether they're distorted by seasonals in an unfair or misleading way. But the fact of the matter is that we have billions of dollars of trading going on from people who are putting stock in those numbers and who are not really spending any time worrying about the credibility or accuracy of those numbers. They are what they are. The seasonal revisions that some people are talking about were very well telegraphed ahead of time. And I shouldn't say seasonal revisions, I should say benchmark revisions. And what this means is that the BLS, the Bureau of Labor Statistics, goes through the labor market with a fine-tooth comb every March. And then the following January, which is reported in early February, those new benchmarks basically reflect a weighting of where people have jobs in the economy. So if things are changing over time, like people are no longer making printing presses, now they're making computers, you would want to make sure that when you see a bunch of people show up in the computer making category, that you are weighting that correctly for the population. And that can have a big impact when things are changing rapidly, as they have been in the post-COVID economy. And this was yet another instance of benchmark revisions having a big impact on the February report, which is for the month of January. Same thing happened last year, and then things started to come out in the wash as the year progressed. So that did have a distortion impact on the jobs numbers, and traders understand that, and they can actually look past that to some extent. And it's a very easy thing to do to look at something like the unemployment rate, which is not subject to those revisions in the same way, and see that that was 3.7 versus 3.7 last time. That is still a low number, and it was lower than expected. Wages rose more than expected. A lot of people quickly pointed out that is likely due to the winter weather events that were happening in January. So that is not necessarily a big source of pain for the bond market. But the fact is, even after considering the benchmark revisions and the winter weather distortions, the report was still very strong, and not the kind of report that goes in line with a lot of the momentum that had been building toward a March Fed rate cut. And some people even thought, up until last month, the January Fed rate cut, clearly we're past that. But just goes to show you that heading into the new year, there was a ton of optimism for even lower rates, even though we had already seen a big decrease in rates in November and December. This doesn't mean that we can't have lower rates in 2024. It just means that the outlook is becoming more balanced in the short term. The Fed is the first to remind us that it is more about inflation than about the labor market. The labor market's kind of a single-edged sword right now for the Fed, because if it gets much weaker, it would be an incentive to cut. But if it gets stronger, if it stays strong, it isn't really an incentive to hike rates. They would need to see inflation increasing or have reason to believe that it would be increasing in order to hike rates from here. Several Fed speakers have been out since the jobs report, and they have said that they still see rate cuts in 2024, just not quite as soon as the market was expecting. And whether we see them or not, and when we see them, it will depend on the evolution of economic data, and especially the inflation data. We don't get the next big report until next week. But in the meantime, we have the Treasury auction cycle this week, as well as a couple mid to upper tier reports. The first upper tier report is already out today. ISM non-manufacturing, stronger than expected, higher prices than expected, higher employment than expected. And so that is adding to this snowball sell-off in bonds, pushing average mortgage rates up and over 7% again. And it's not pleasant in the short term, but if the data levels off, and especially if the inflation data is in line with expectations or better, then the rate trajectory can calm down and maybe get back into a trend that many were hoping for at the end of 2023. That's going to do it for today. Back to you.